Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guests are Leins and Matthew Green. Thanks for being on the show, guys.
Hey, thanks a lot, Whitney. Glad to be here.
Pleasure to be here.
Prior to ResProp, Luke scaled and built out a third-party multifamily platform for a top four property management firm. He's also an accredited investment fiduciary and a CCIM candidate member. Prior to ResProp, Matt worked as an associate director of acquisitions and development at a Dallas-based multifamily investment firm, and is also as an analyst for a REIT with over $12 billion in assets. He's overseen the acquisition of over 5,000 apartment units. Together, they bring prior entrepreneurial experience and institutional real estate experience to every deal and are skilled at conveying the integration of technology to multifamily owners. So Luke and Matt, thank you both so much for coming on the show and providing your expertise to the listeners and myself. Give us, a little update, or tell us, who you are and what your focus is right now. And let's jump into some of these great topics.
Sure. Well, the market right now, the multifamily market, is more or less a victim of its own success. Most everyone to a T in the multifamily industry, to some degree, is a deal junkie. I mean, it's what makes us get up in the morning. It's what makes us port, over hours and hours, whether it's over spreadsheets, whether it's analyzing markets, whether it's taking the time to get in our car and drive however many miles, to the property and really get down in the weeds. And it really, it's a victim of its own success. I mean, deals are very, very difficult to win right now. The better the deal, it seems, the harder it is to win, especially in the Sun Belt markets in which, Luke and I both reside. And we kind of saw the opportunity to, as a service provider, to provide, in an environment where we can no longer take cap rate compression for granted. Not saying it's not going to happen. It generally does happen over time, but it's just right now we think we might be at a point where it's harder to come by. So then you have to ask the question, what are the other levers you can pull to make a deal great, make a deal successful? And the answer is NOI. And so you do that at the property level. And that is what really what was the question we sought out to answer, what our founders sought out to answer, and what we're doing every day now.
Awesome. So I wanted you to elaborate. And I know some listeners are very experienced in this business, and some are just getting started. If you could, you mentioned cap rate compression. I know we talk about that often on the show, but if you could just briefly say, okay, what that means.
Sure. So briefly, as everyone knows, the cap rate is the mother of all metrics that we use, for how much money we're going to make, at least on the exit of a deal. It's the ratio of your property's NOI to the sales price. So in a lot of primary markets, in New York and San Francisco, LA, it's not uncommon right now to see sub 4% cap rates. And obviously it varies, for different property sectors. For industrial, for office, for multifamily, you're going to see different cap rates. But in general, right now, multifamily, it depends on the market. But here in Dallas, for example, we're starting to see, an A quality asset, like a core asset, you might see somewhere around 5% or even below. B and C assets, which I know is the bread and butter of many of your listeners here, and indeed it was ours for most of the past decade as well. It's more common to see. Well, you want to see it higher, 6 or 7%. You're not always seeing that, which and I think that was one thing that led us. We're seeing, this deal is going to be successful. If we assume a 6% or 5.5% exit cap rate in 5 years, well, all of a sudden we found ourselves not entirely comfortable with those. And so you can't always assume it's going to go down. But basically, the lower the cap rate, the more the market is willing to pay for the cash flows coming out of the property. And so if you're entering into an era where there might be an expansion, like a recession, that really, really increases the risk profile of any deals that you're doing.
So, you talked about other levers that you pull to make a deal great. And you talked about, okay, that's the NOI. And so what are some ways you all are achieving, greater NOI?
So what Matt and I do at our company, we're kind of the acquisitions equivalent of a management company. Kind of our day-to-day is we work with clients and we really help them analyze deals and evaluate deals. So we work with, large firms who handle pension money, down to small syndicators who might have 80 different equity sources for a $5 million equity check. So we're working with a lot of different people, and really what we're doing is evaluating underwriting, evaluating opportunity, and we're always looking for 3 or 4 good levers, 3 or 4 positive impacts to NOI. So the first and most obvious is probably going to be renovation potential. So can we renovate this property? Are there renovation comps in the area? If we invest $7,000, can we get $210 monthly return on that, which would be a great return? Or are we in a market where, there's an A property down the road that is getting only $120 more? So we're always looking for renovation potential. Other income growth, valet waste has come on strong. That's always a fantastic other income item. That costs between $8 and $12 a month, and you're charging residents between $20 and $30 a month. So layering in programs like that. One area we're still seeing a lot of opportunity is utility reimbursements. Certainly not the sexiest income item, but there are a lot of situations where you're seeing a flat utility reimbursement of, say, $30 when an 85% REVS program would get you $80 or $85 a month, which doesn't look like a lot. But when you're talking about a 5 cap, meaning every $100,000 of NOI gets you $2 million additional dollars of sales price, those little dollars and cents really add up. And then the area where we're really, I don't want to say we're heating this area, but we're trying to be a great resource is a lot of underwriters, a lot of investment groups, they really start using rules of thumb when they're underwriting deals, which gets to be very dangerous. If you're looking at a deal and you say, payroll is typically $1,100 and R&M is typically $300, and you're just using rules of thumb, that's fine and good when you're running the deal. But you really need to get granular in the way you're looking at these expense items. So payroll, are we in a heavy payroll market? What do we actually need to pay people to get them to come work on our site? That's very important. You look at maintenance techs, they make between $16 and $20 an hour in most markets. So you're looking at $20 an hour, it's about $40,000 a year. And you have to factor in that burden. There might be a bonus attached. There's going to be employee benefits, payroll taxes. Then you're looking more at $55,000, $60,000 for that person. So we're always very cognizant of payroll. We're always very cognizant. When we underwrite deals, we kind of go GL line by GL line, and we get very granular. And we've been really encouraging people in this hyper-competitive market to do the same thing, because you're going to find opportunity that you wouldn't otherwise see, but you're also going to recognize areas where your underwriting might not be completely accurate. So really, our whole job is to work with vendors, work with our clients, use the robust information sources we have, and really provide the best information we can.
So what are some ways, maybe through technology, that you've been able to add more value?
Sure. So one thing we've been looking at, and this is something we're awfully excited about, is, like I mentioned earlier, when you're looking at a 200-unit property, you're probably staffing that with 4 people, and the direct payroll might be $200,000, and then you have an additional almost $100,000 of burden. Which is great, but again, we're looking to make these properties efficient as we can. So one thing we're looking at doing, we're piloting a tech platform called Get It Done. So what we're essentially doing is we're creating a gig economy in the maintenance side of properties. So we have on a 300-unit property, we actually ran that property with 1 maintenance supervisor, and for all of our work orders, we actually contracted those work orders out through this app, similar to how you'd see Uber contracted out. So you type a unit turn, you type a work order into the app, and you actually get real-time bids from vendors. So you're only paying for that labor on demand. So we think that tech is really going to go far in multifamily. It's tough to staff. Multifamily is cyclical. You have more work orders in the summer and winter months. You have more move-outs in the summer months and move-ins in the summer months. So your payroll is never quite accurate. So when you pull out some of your W-2 labor, and you factor back in 1099 contract labor, you're only paying for labor as needed. So that's become a really great opportunity to decrease that payroll burden, which again, if you can decrease your payroll burden by $100,000 on a property, again, when you go to sell that thing, that's $2 million. And
That's a big deal. Yes, that's a big deal. Very interesting. So then you hire them as needed instead of having somebody that's full-time or numerous people that's full-time.
Yeah. And I also might add that, think about this from a proportionality standpoint. This can benefit those who are getting off the ground and scaling their businesses the most, because often those are not the ones who you don't even have enough units to, have the means to pay for professional management. So really, this is really an answer to a lot of those, who are really pounding the pavement every day and having to, build their own network of contractors. And now you can do it, it's as easy as having an app right there in your hand.
Nice. So I wanted to touch back too on something you were saying, Luke, about you're talking about using rules of thumbs. It gets dangerous, and I liked how you all were talking about you're going more granular. But how are you finding the information, and how do you know that it's accurate?
So we have a robust portfolio of both owned and managed properties. So we have real-time access to what we're spending every day, every month on each one of these properties. And typically we have a couple of competing properties in the submarket that we can use for information. So when we're looking at a deal, we actually have, in the state of Florida, if I'm looking at payroll, I can actually go into a system and see what each one of our employees is making. So when I'm looking at a deal in Tampa or St. Pete, I know that we can probably get a maintenance tech for $17. If we're in a different market, it might be $19. So we're able to get really granular there. And when it comes to, R&M, we have a very robust vendor network. So I can reach out to vendors and I can say, hey, take a look at this property. What's it going to cost to run landscaping here? What's the pool contract going to cost? And then obviously we have our robust spend, so we can look at our R&M costs and competing properties. We have maintenance techs, we have maintenance supervisors who can actually go out to properties on our behalf and on behalf of our clients and walk the property to see what R&M might look like. So we have a robust team of professionals, and they're all aligned to really help us underwrite these deals very accurately.
So what about some other underwriting techniques that you all are implementing now? I know everybody's worried about where the market's going, and I know we're going to talk about, just the future of multifamily, I know, and what you all are looking at. But what are some other underwriting techniques that you all have implemented with where we're at in the market right now?
I always challenge people. I say, see if you can make this deal work without underwriting any organic rent growth.
Yeah.
And that just seems important to me, because I do see a lot of guys leaning on rent growth, market rent growth, and I'm seeing guys underwriting maybe 7% for 3 years. And if that's what you're leaning on to make your deal work, it concerns us. And we're here to help. So really, can we find 3 or 4 things in this deal where we can make money, where we can increase NOI? That might be a decreasing of some expenses. Like I said, that might be a reimbursement program. We're gonna walk around the parking lot and see if we can charge extra income or put carports into sunny neighborhoods to see if we can get another $35 for these carports. So really, the goal is always, can we renovate the deal and make money? Can we add additional income items and make money? And can we streamline expenses? And if you can hit 2 of those 3 things or 3 of those without underwriting any organic rent growth, well, then if the market grows, you're just doing even better. So that's what we've really been pushing, is really try to find those key kind of smaller items that are going to have that impact.
Nice. And I know listeners are wondering, could you tell us what type of underwriting tool you use, or maybe it's one that you built yourself?
Sure. So we've used a few different tools. We've actually moved into the Red IQ system. So shout out to our friends over at Red IQ.
Cool.
Reason being is we underwrite a lot of deals. Every one of our clients, we're underwriting all of their deals. So we have quite the workload. So Red IQ is a great tool. We can dump things in and it kicks out a model. And it kicks out a very accurate model where, if you have the accurate back-end data, we kick it into the different categories and it just kicks out a model. So
That's awesome.
Worked out really well for us. Yeah.
We've also started using Red IQ and just recently. So there's some learning curve there, but I think it's going to be great.
Yeah, it sure is. And then we also have a home-built staffing template, which a lot of our clients, I say, here's a model, here's a staffing model, and then take this template because it has the burdens built in, it has the bonuses built in, and really, it really helps guys to understand if you're paying someone $20 an hour, what that actually looks like as an all-in cost, and that's really important.
Yeah. Any other ways that you all are operating more efficiently, or through management and lowering operating costs that we haven't talked about?
Yeah, something we've done, and we're relatively unique here, is we actually brought in a commodity purchasing team. We brought in 3 commodity purchasers. The gentleman who heads that team up came from Rolls-Royce, and he was buying jet engine parts for Rolls-Royce. And so he was aggressively and proactively negotiating those costs. So we brought this team in, and I know others may be doing something similar, and it's a great practice. It is instead of taking in vendors as they come and as they find you, they're actually going out and they're finding vendors in each category, and they're having them aggressively bid against one another. So we actually have what I believe the cheapest prices in the country. I don't want to say vendor names, but with a few big vendors, we have the cheapest prices in the country, not because we're the largest, but because we put them head to head against their biggest competitors and said, may the low number win. So that's been huge for us. It's been a great cost saving technique. It's really pushing every dollar we spend. Is that the best bang for our buck for that dollar? Our marketing team is doing the same thing with all of our marketing capabilities. We actually just rolled out a program where we're breaking our SEO up in markets. So instead of paying per click for a single property, the properties all pool their resources, and you actually click into a list of all properties in that single submarket. So that's been able to shave quite a bit of marketing expense off of a number of these properties while still having the same marketing presence.
Tell me that again, or elaborate a little bit. You talked about, I've never heard that before, breaking up SEO per markets.
So the way it typically works is, let's say I'll use St. Pete as an example again. Let's say we have 5 properties in St. Pete. Each one of those properties is running their own Google SEO PPC campaign, and each one of them is paying the full cost of that campaign. Now, what we did is we built a landing page for all of our properties in each specific submarket, and it's the same cost. So when I Google St. Pete apartments, instead of having apartment 1, apartment 2, apartment 3, apartment 4, apartment 5, it's all of our properties. And you click to a landing page, and that displays all the properties in that market. So it's a way, effectively you're paying 1/5 of what you otherwise would.
Very creative. No, I like that a lot. Like that a lot. And, and I know, the future of multifamily, it seems to be changing. A lot of people are talking about what's happening. I wanted to get your all's take on just, what you see in the market and what you see in the future.
Sure. So multifamily is, and I think everyone would agree, a relatively stagnant industry. So we really see a lot of technology, not just ours, a lot of technology coming out that can fundamentally transform the industry. And the exciting part for investors is eventually it's going to change how you underwrite deals. Now you see on our side, the maintenance side, we already talked about, if you can underwrite understanding that contract gig-based system, you're going to save some money there. But we're also seeing companies, I'll use Rent Grata as an example. Rent Grata is a tool. They actually have on their property landing page, they have a little icon where you can actually click and talk to an existing resident. And the resident tells you about their experience on that property. Now, if you sign a lease, that resident's getting that referral fee. And that's pretty exciting to us. Now, the next step of that is, and I will say really quick, you're seeing companies like UDR actually centralizing some of the office roles on property, which is far more efficient. But then on the leasing side, if you could have a resident who's incentivized with a referral fee to bring people into the property, and if they have a system built, now imagine if the residents were able to tour prospective tenants on the property, take them into a model, show them around, and give them a true resident feel for the property to make a referral fee. Well, that's also going to scale back your office cost. And that, again, that just changes everything. You're eliminating W-2 payroll and you're paying referral fees only when leases are signed, which you're already doing anyway. And for both those reasons, if there's one piece of advice I'll leave guys with is when you're renovating properties, think about using smart locks. Because our gig economy system, our get it done system is done much easier when someone can just type a code in to go do a work order. And when it comes to, eventually when residents are actually touring prospects, if they have a code they can type into that model, that's a lot easier. So smart locks is actually going to play a big piece in the future of multifamily because we are trying to create a gig economy. You're seeing companies like Post in Dallas. They're already centralizing their leasing office in submarkets. So they have a single leasing center in Uptown Dallas for all their properties. That's an efficiency. That means that each one of those properties is running more inexpensively. And that's what we're looking to do. So we're not the only ones doing it. And I think there's going to be a suite of technologies here in the next 2 years, that's going to fundamentally transform the way we look at deals. And that's really exciting to us.
What was that platform you mentioned that will allow a potential resident to talk to a current resident or message back and forth, and then they'll get a referral fee?
It's called Rent Grata. Shout out to Ben and Sam. They're based in Chicago. Really great company. RENTGRATA. And they have two ways of doing it, but you actually pay per lease. So you're paying them per lease that's signed through their platform. You're paying the resident per lease that they help you sign, which is exactly what we're looking for. You look at Uber, you're paying per ride, and we're doing the exact same thing. We're paying per work order. Eventually, properties will be paying per lease with no leasing overhead, and that's really exciting.
What has been the hardest part of the syndication process for you all?
Matt?
Well, truth be told, maybe it would be helpful to give some of the history. So, our founder, Peter Rex, he's currently based in Seattle, but they were based out in Tampa. He got a pretty hefty seed investment back at the beginning of this decade, and built that up into what became a 17,000 unit portfolio. So in terms of syndications, we as a company have always had a core group of investors to go back on. That said, though, we've really been hitting the pavement, and really our day to day, really getting down in the trenches and building up a client list has actually been on the when we made the decision to start doing this on a third party basis, in terms of the management company. So Whitney, I assume when you were asking that question, you were going in the direction of what is the biggest aspect of our hustle, right?
Yeah, sure.
Okay. Yeah, and what I will say is, so we had great internal systems, great internal processes, great internal support staff, wonderful property level teams, which enabled us, with InvestRes, most of the past decade, we were in the top quartile, quarter in, quarter out, in the frequent rankings. And then we decided, to kind of put the brakes on being an acquisition shop and just see kind of what happened with the economy the next couple of years. But you have these great property level teams. You want to keep them in house and be able to offer, FP&A, accounting, human resources, all the great departments we have within ResProp be able to offer those institutional quality to help smaller syndicators as they are building and scaling their business. And that's been we had a good reputation in Texas and Florida, but that does not translate to building up a portfolio on a third-party basis. So we came in and that is our basic the value-add proposition. We have institutional quality systems and departments and support structure in-house for you. But at the same time, you have to be able to strike and identify deals that are going to transact, because most multifamily owners and operators are not looking to switch a property manager every day. It's either from the get-go, when the deal gets off the ground and is acquired, or if the deal gets in trouble at some point down the road. And at this point in the economy, we're not seeing too many deals get in trouble. The ones that we are seeing from that perspective are ones that are truly mismanaged. And then you do see opportunity. But for the most part, it's been a lot of networking, a lot of going to conferences, tens of thousands of phone calls. And so, it has just been the day-to-day grind, not knowing where the next deal is going to come from. And we're still doing that every day.
Nice. And, how do you all, I know we talked about it briefly, but maybe you can give us just a couple pointers on how you all are preparing for this potential downturn that everybody's talking about.
Yeah, what we're looking for is, does the property have, and again, going back to challenge as a syndicator is often you're looking at investors, and that investor is saying, well, what happens if the market does turn? And so you always want to have some level of hedge in place for that. So that's why we look for it. Like Matt mentioned, there are still a lot of properties out there that are run kind of we use the mom and pop term. You look for those mom and pop capacity terms. That means that you're going to be able to, I'll say, professionalize every aspect of that business. And again, we're talking about those 3 or 4 things. If you have 3 or 4 things that make the deal work, 3 or 4 things that are going to increase your NOI, then a downturn doesn't hurt so much. But if you're really relying on one thing, we often see guys who are really relying on just that renovation. They're saying, I'm going to put in $7,000, and as a rule, I'm going to get 28 or 30% ROI on this. Well, that renovation might be in a market where you have a lot of properties renovating, which is going to create almost another lease-up type scenario, lease-up competition scenario, where everyone's trying to fill those renovated units. So as great as renovation returns are, and that's what most of us are looking to do, is fix properties up and refresh them. A big part of it is also make sure you have 1 or 2 other things. Also make sure you can increase other income. Also make sure you can make expenses a little better. Make sure there are 3 things. And again, if you're not underwriting organic rent growth and you're still able to make your deal work, well then if there is no organic rent growth or even negative, you're going to do okay.
So a few more questions before we run out of time, but what's a way that you all have recently improved your business that we could apply to ours?
Yeah, so we just recently, again, we have been actively seeking out vendors. We just recently overhauled all of our systems. So we were using one of the larger property management softwares. We switched to a new software, a smaller software called Resman. Reason being they have open API feeds, which is getting a little techy. But what that enables us to do is that enables us to choose every vendor. So we're not locked into a specific CRM. We're not locked into a specific purchasing software. We can use whatever the best and most recent technology is. We can now plug that into our system. So we've really tuned ourselves, and switching over all your softwares at once is obviously very painful. But it worked out great because now we're a very tech forward. We believe in tech company. As these technologies come out, we built an entire property management system around being able to adopt those technologies quickly. So we're really trying to position ourselves as a pioneer. So when a new technology comes on, we can just build an API pathway into our systems and integrate it. So that's been really exciting, and that was a big investment for us. And it just really shows that we're very much believers of the technological future of this industry.
Yeah. So guys, tell me the one thing that has contributed to your success.
Sure. Yeah. The big thing obviously for Matt and me is helping guys, understand what realistic expectations are on properties. And actually one of my favorite things to do, and I'll probably get in trouble for saying this, is I love telling guys when I don't like a deal. Because there are a lot of deals out there that maybe aren't the right deal. And so the toughest thing for an investor is to know when to say no to a deal. And something I love doing is helping guys to understand whether or not a deal's good. So one of my favorite things about my job is telling guys when a deal just doesn't make sense to us as a manager, which likely means that it probably shouldn't make sense to them as an investor. Beyond that, we have a great, robust operating team. And, something that's been so important to us is just open lines of communication between our property management teams and our ownership groups. We love meetings. We love weekly, bi-weekly meetings. And those open lines of communication are so beneficial. So as an investor, even if you're a one-man shop, don't just let your property be run. Don't just let us run your property. We're great at it, but we want to hear from you. We want to hear your expectations. We want to hear your feedback on decisions, your ideas, because when we work together, that's when our properties perform best.
Yeah, and I would also add to that and just say, we having acquisitions backgrounds and having done this, we understand that, what we are reporting to them, they're reporting to their investors too. So it's always, especially from a property management perspective, basically give them everything they're going to need to have that same kind of upfront communication, no holds barred, everything upfront with their investors, and that's what they really appreciate. It goes along, hand in hand with communication, open lines and being upfront, 100% communication before the deal, during the deal, and as you're winding down as well.
Awesome. And last question before we have to go, how do you all like to give back?
So this has actually been a central part of the ethos and the practices of our company since the very beginning. I can tell you that in 2010, we were founded in Tampa, Florida. Peter Rex and Nate Fisher and Peter Rex's brother and Dan French. They were the 4 main guys early on. By 2016 in Tampa, they had helped establish a Catholic Christian preschool, I believe, and they also had a partnership with a local high school, Cristo Rey, to actually bring youth into and have like high school internships and working at the office for underprivileged youth. That is just one example. But I will say that as a company, one of the things that attracted me to come here in the first place was the high level of sense of obligation to give back, whether that is in a business sense and, help, Whitney, just like you do, essentially, because what we're doing is helping to mentor, new and give advice, to new syndicators getting into the business, that, and then also on the nonprofit side as well.
Very nice. Very nice. And what does it look like for some, I know the listeners are probably wondering too, what does it look like for them to work with somebody like yourself or run a deal by you all?
Sure. Really, really all it takes is, and Matt and I, more than anything, we just love talking real estate. So, there's no one we don't want to talk to about a deal because our job is to talk about deals. So, as far as reaching out, it doesn't matter the deal. It doesn't matter the market. Just shoot us an email, a phone call. And really, we look at the deal, we look at the LM, the financials, and we really just have a conversation, shoot the breeze over that deal.
Nice. And how can people get in touch with you all?
Sure. Email is probably best. My email is lleins@investres.com. Matt's email is mgreen@investres.com.
Yeah. MGREEN, like the color. Yeah.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.